My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey folks, welcome back. Today we have a special guest who's kind of moved from the single family space into multifamily real estate investing, zooming in from Queens, New York. We have a very accomplished real estate entrepreneur, Shmuel Teitelbaum. Sam, how are you doing? Welcome to the show.
I'm doing great, Dave. Thank you for having me on.
So, Sam, give us a little snapshot, first of all, of what your portfolio looks like as of the end of 2025, which is kind of when we're recording this.
Sure. So we still hold some of our single family homes, the one that we started our portfolio with. And at the moment, we're essentially focusing mostly on multifamily, larger multifamily throughout the country. And for now, we're in about 3 markets in the multifamily side, and we're constantly looking to expand.
Nice. So are you a co-GP on these projects? Are you the primary sponsor? What role do you play?
So our basic philosophy is we try to learn from everyone else's mistakes.
Yeah.
So when we started out, we with my background mostly in single family houses and decided, hey, we want to go for the larger multifamily. We sought out co-sponsors that were very similar to us, but were probably 2 to 3 years ahead of us in the game.
Smart.
And we said, hey, it's a big country out there. We're hitting the pavement every day looking for deals. We will bring you deals. We have some relationship with investors, but obviously you have more experience and a better reputation. How about we do this together? And we've done it. We've learned a lot about partnerships over the couple of years doing this, but
the
it's
good,
been
bad, the ugly, I'm sure.
but for the most part, it's been an excellent experience.
Good.
We really gain from other people's experience. We right now work with 3 separate groups. Each one has a different approach to how they do real estate, and we've gained from all of them.
Okay, so what I was hearing you say is that you're finding people that are a step or 2 ahead of you on the experience curve. They got a track record, and then you're bringing the deals to the table for them and helping raise capital, or what are you guys' primary responsibilities?
So in theory, that's the way we set out to do that. On our first deal, we brought the deal to the table. The second one, actually, someone we've been looking at deals together with. I'm sure you know, you look at hundreds of deals before one actually makes sense, even on paper. So we actually, some of these people we have great relationships with. We tour deals together. We bounce ideas off each other. We go through numbers together. So the second 2 deals actually were brought to us.
Mm-hmm.
It's sort of a give and take who brings the deals, but our general way we look at our partnerships is we don't get very nitpicky on who brought, who found, because the way we look at it is we're getting into a partnership for the next 5 or so years. We're all in, we're all hands on deck. So some we brought, some our partners have brought.
Right. Okay, cool. And once you got the deal up and going, do you folks have any hands-on involvement in the administration of the deal, investor relations?
100%. 100%. We're like I said, we're all hands on deck for everything. We're in that in-between stage between self-managed and third-party management, but we're all on the asset management. So we're all going down to the properties twice a month. We're all on the management calls, dealing with the CapEx, the construction projects that all of us do all the time. And we generally say, if you're not constantly questioning why you're not self-managing, you're not asset managing hard enough. So 100%, we all essentially wear all the hats.
Okay, cool. So when did you start actively getting involved in multifamily, Sam?
So I'm trying to get you a timeline. My wife and I were doing single family homes in Baltimore from about 2016 to 2019.
Doing flips or long-term?
Both.
Yeah.
We were doing both at the same time. My idea was do enough flips so you can build equity to own a portfolio of rentals. I figured that was the way to do it. I decided that I wanted to go into multifamily after a while. So what I did was I actually taught myself how to do modeling, Excel, financial modeling, mostly off YouTube. I actually built a phenomenal model that I use till today. Showed it to a couple of companies. One of them actually hired me. I did their acquisitions for about a year and a half.
Nice.
Focus most.
Paid to learn as well. So that's awesome.
It was a phenomenal experience. But at some point, I realized there's not much value I could bring in here. They kind of have their systems. It was a great time, but then I jumped off on my own. That was right before the rates went up.
Mm-hmm.
So we were looking at the market, and we were underwriting for about a year. And we were underwriting with the current rates, and we always did the same exercise. Hey, rates are now. What happens if they go up to 4.5%? What happens if they go up to 5%?
What happens if they go back to normal?
Exactly. And everyone told us we're being unrealistic. This is the new normal, and we would push rates up to 4.5%, and all the numbers would go red suddenly, and we'd be outbid by $5 million. So, thank God we stuck to our guns. We didn't buy anything until after the rates went up. And then we bought our first deal, which was about a 6.5 cap, fixed debt, agency loan, and then we've been doing that since then. We've been doing that. That's been our model.
Nice, smart. So you got in after the kind of the, hit the fan. So that situation has not affected you negatively. Have you seen any challenges with the market over the last couple of years that you guys have been in?
100%. We thought we outsmarted the market. Hey, we were the guys who didn't buy the floating debt, but we're still getting the end of that in a few ways. We started out in Atlanta. It was our first market.
Yeah.
We didn't think COVID would last so long and its effect. The biggest thing we found in Atlanta was they shut down evictions for probably an additional 2 years. That really affected the Atlanta market.
Holy stuff.
Which in a way we were very conservative in how we underwrote deals there. But what we found was everyone was 100% occupied because there hasn't been an eviction in 5 years. So the rates kept getting inflated. The rent rates were inflated because everyone was 100% occupied, but everyone was about 40% bad debt on them. So what happened was when Atlanta decided to rip off the Band-Aid, everything got shaken up there. So that was something we didn't avoid, even though we got our fixed rates. One thing we're finding that's affecting most markets right now that I don't think people really expected as much is all that very low cost capital led to a lot of development. And that's all coming online now. So we're in several markets. We see softening on rents across every market where we're seeing and we're accounting for softening in the rents.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Okay. Yeah, that's a big challenge, isn't it? But it's ebb and flow, that's for sure, because now it's so darn expensive to build that, everybody.
Correct. I don't see any new development starting. I feel like the tail end of the development is coming online right now.
Yeah.
So we think, do what we're still doing what we're doing. I think the absorption is catching up, and we're going to be in a good place next year.
That's great. So how many projects or communities or deals, multifamily wise, do you guys have on the go right now?
So on the multifamily side, we're currently working on closing our 6th. We have about 1,000 units, right? We have about 1,000 units. Thank you.
So is this your full-time gig now?
It's my full-time gig right now. The single family home days were when you all have all the side hustles and everything just sort of to get it going. Yeah. But this is my full focus now.
So you got to learn in the trenches working with another company with acquisitions. So that was good, get paid to learn kind of experience. The other side of the coin is the capital raising side of things. So what have you discovered over these 6 deals when it comes to raising money for your projects? Outside of money.
It's a great question. Capital raising has changed a lot. I mean, when I first started looking at deals, you had a deal and you were fully raised before you were under contract. There was just so much capital going around, and people like to think, oh my gosh, it was so much easier 5 years ago. There was so much capital. I'm like, it's true. There was plenty of capital going around, but there were no good deals. The deals didn't work. And now I find there's so many good deals, but the capital is scared. So the way I always say it is there's good deals and then there are deals you can raise on. There are markets that I would love to go into right now. And I think there's so much opportunity and so few people are looking into them right now. But I know that so many people have been hurt in those markets that I have to walk away because I know you cannot get capital for these markets. And then there are other ones that they're safer deals. They don't necessarily have that exciting pop to them, but my investors are happy to know that they can get a agency loan on it, fixed debt, and they're going to make their 6, 7, 8% going in. I find now those are the deals we have to focus on.
Interesting. All right. So when you're first raising capital, did you do like most folks where you're kind of focusing on connections, friends, family, that
100%. You go through your phone contact list, and
we used to call it the Rolodex, but nobody knows what the heck.
Exactly. So now, right, so the Rolodexes are not a thing anymore. Yeah. But you go through your contact list. You get over the awkwardness. I think the first few days you do raise, you sort of look at and cringe at the phone, and after a while you just get over it.
Yeah. So so I've heard a few folks say kind of what you're talking about, like their current group of investors were kind of used to things back in the go-go days. I don't know if your gang was or not, but then they got burned, or now they're kind of stuck with some deals so they're kind of super conservative or sitting on the fences or getting out of real estate altogether. So it's hard to kind of get water from that stone kind of thing. But on the other hand, there are thousands, if not millions, of potential investors out there who are accredited, who do have the income, who do have the net worth, but who don't have experience in multifamily yet. So that's kind of like a blue ocean of opportunity there, reaching new investors. Are you focusing at all on that?
We are. Every deal we do, we get a tremendous amount of new investors, people we've spoken to. And there are people who will say no for our first 4 deals. 5th deal, they're like, you guys are still doing that? And then they'll come in, and these are our best investors. We like starting close to home at first and then going out. It's something that I have found, especially when, a deal you have a bad quarter, things don't go according to plan. Who your investors are almost as important as who the sponsor is.
Yeah.
We've found investors that, we're always incredibly transparent. Our line is, we make 2 guarantees to investors. One, we're going to have bad quarters. Our second guarantee is we're going to call you and say, hey guys, we're having a bad quarter. We don't.
I like those guarantees.
Yeah, it's what I can stick to, right?
Yeah.
We don't hide a bad quarter. We don't say, hey, we will tell you when something goes wrong, and we'll tell you what we're doing to fix it. The difference when I know an investor who I know and I can call them and say, this is what's going on, and they'll say, hey, Shmuel, we've seen it before. Thank you for telling us you got this, versus someone who will freak out on us. It makes such a difference in how you can run your properties. So we're really not comfortable taking money from people we don't know.
Yeah, no, that makes sense. So now that we're going into a new year pretty quickly, what do you have on the horizon, on the timeline for 2026?
So we're actively working on closing a deal right now. Similar, we try to get fixed debt above a 6 cap, and we're closing that one. My focus right now is learning the self-management game. We've relied on third party until now. I think going forward, we have to figure out the self-management game. Not necessarily I don't think there's much money to be made in management if you're doing it correctly.
Yeah.
But I do think that your properties do significantly better when you do it. So those savings go to your property. You'll see the money on the back end, and you have so much more control over what happens. One thing we've learned from our first few properties is you have a property that's going great, and then some corporate politics on your third party, and suddenly they take your amazing regional, move her to a different place, and suddenly, so we want to have that control, and we want to have that control on expenses. I think if you can control the expenses and have much more control on your staff, and you can overpay for good talent, even though you won't make money on the management, you could actually come out of pocket sometime in the management, but your properties look so much better.
Yeah, which that's the biggest bang for your buck anyhow, right? That's
Right. Now,
So-
I always ask myself, if I don't see a way to be profitable in the management, my third party management, they're making money. So where's the disconnect? I think something is coming from the property. It's not your regionals get overloaded is something we see a lot. Things that can be run more efficiently are not being run more efficiently. So that's, I think, the direction we're going to be focusing for the next year or two.
Interesting. Yeah, it makes a lot of sense. So as we're wrapping up the conversation here, Sam, you've been in single family homes, flipping, long-term buy and hold rentals. Now you're in multifamily. Compare and contrast what you like and what you dislike about multifamily versus your experience in single family.
It's a great question. I feel the multifamily space is more, I would say it's a more cerebral than when I was doing single family homes.
Okay.
Like I'm not the handyman. I'm not hands-on. I'm not painting units anymore. I'm not the plumber for all of these things. There's something emotionally more, you're a little bit more far away from the property. You're a little less emotionally attached to the tenants and the actual property than when you're
a little bit more objective versus subjective.
100%. I remember my first eviction. I was in tears when I was doing it. And when it's a third party or larger buildings, in a way you're able to be much more objective. So I definitely like that part. What I liked more about the single family homes was there was a lot less cooks in the kitchen. There were a lot less people to deal with, a lot less. You're not dealing with 3 levels of staff. It's just kind of you and the utility bills and the maintenance requests. So I guess that's how I would see the difference between the two of them.
No, that makes a lot of sense. Sam, this has been great. If people want to connect with you and find out more about what you're up to, where should they go?
Shmuel Teitelbaum. I'm available on LinkedIn. I try to respond to most messages. Don't get to all of them, but I feel like that's probably the easiest way to get a hold of me.
Fantastic. And I'm thinking there aren't too many of you on LinkedIn, especially in the Queens. Yeah.
No, exactly. I mean, if there's 2 Shmuel Teitelbaums, I'm one of them, right?
And probably the only one.
Exactly.
Nice. Shmuel, thank you so much for being on the show. This has been great.
Dave, thank you for having me.
All right, everybody. See you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.